Welcome to Proficient Financial Planners YouTube channel, Financial Education and Awareness Series. Welcome to our comprehensive guide on Indian mutual funds. In this video, we'll explore the main categories and subcategories of mutual funds available in India. Let's start with the basics. Mutual funds are investment vehicles that pool money from multiple investors and invest in shares, or bonds, or other financial instruments. Mutual funds offer several advantages, including professional management, diversification, affordability, and liquidity. Now, let's dive into the main categories of Indian mutual funds. First category is equity mutual funds, which invest primarily in stocks and offer the potential for higher returns over the long term. Now let's understand the various subcategories of equity mutual funds. Let's understand large cap category. This category of funds invest primarily in large-sized companies. Consider as India's top 100 companies by market capitalization. Out of 100 companies, first 30 companies are also called as blue chip companies. Generally, top 100 companies have a market capitalization of more than 20,000 crore rupees. Focus on businesses with stable earnings and well-established track records. Typically have lower volatility compared to other categories. Offer relatively consistent performance during market fluctuations. Provide high liquidity due to investment in large-sized companies. Indexes like Sensex, Nifty 50, Nifty Next 50 and Nifty 100 are the part of large cap universe. Let's understand mid-cap category. This category of funds invest in companies ranked between 101 to 250 in market capitalization. Also called as emerging companies. Generally, these companies have a market capitalization between 5,000 crore rupees and 20,000 crore rupees. Offer higher growth potential compared to large cap funds. Carry higher risk due to the relatively smaller size of companies compared to large cap funds. Some stocks are less liquid due to size of the company. Nifty Midcap 150 Index is part of midcap universe. Let's understand small cap category. This category of funds invest in companies between 251 to 500 in market capitalization. Generally, these companies have a market capitalization of less than 5,000 crore rupees. The growth potential is very high in this category of funds. At the same time, this funds has very high volatility and risk compared to large and mid-cap funds. Some stocks are less liquid or illiquid. Based on the image shown here, large cap companies consist of the top 100 companies, representing the largest and most stable firms with the lowest risk. Mid-cap companies, ranked 101st to 250th, are medium-sized firms offering moderate risk and growth potential. Small cap companies, ranked 251st and beyond, are smaller, with the highest growth potential but also the highest risk. The chart visually demonstrates the relationship between company size, number, and risk, with risk increasing as company size decreases but number of companies are increasing. Let's understand FlexiCap category. This category of funds invest across all market capitalization. Fund manager has a flexibility to invest in any stock from 1 to 500. Maintain diversification across market capitalization and sectors. Let's understand multi-cap category. This category is similar to FlexiCap and funds invest across all market capitalization. Here, fund manager has to invest minimum 25% in each category: large, mid, and small cap. Maintain diversification across market capitalization and sectors. Offer a balance between growth potential and risk. Let's understand index funds. Index funds replicate the stocks of a specific market index like Sensex or Nifty 50. These funds are passively managed and do not involve active stock selection by fund managers. They have lower expense ratios due to the passive management approach. Investments are diversified as they include all the companies in the chosen index in the same proportion. The goal is to match the returns of the underlying index without attempting to outperform it. Risk is lower compared to actively managed funds as they follow a predefined market index. Performance is free from fund manager bias, minimizing human error or personal influence. Some of the indexes are shown here in their composition. Let's understand sector or thematic funds. Invest exclusively in stocks within a specific sector like banking, pharma, FMCG, IT, or defense. Thematic funds invest based on a broader investment theme, such as infrastructure, ESG, power, or consumption. Include companies across sectors that align with the theme. Performance is directly linked to the growth of the chosen sector or theme. Carry higher risk due to limited diversification across sectors or theme. Tend to be more volatile compared to diversified funds. Performance varies with changes in macroeconomic and sector-specific conditions. Require thorough analysis of sector trends and dynamics. Second category is debt mutual funds, which invest primarily in fixed income securities like bonds, treasury bills, and government securities. They aim to provide steady income with relatively lower risk compared to equity funds. Debt funds are suitable for preserving capital and earning moderate returns, often influenced by interest rate movements and credit quality. Now let's understand the various subcategories of debt mutual funds. Debt mutual funds are categorized based on the type of investment instruments and their holding periods. Liquid funds invest in instruments with a maximum maturity of 3 months, while ultra-short duration funds hold investments maturing between 3 to 6 months. Short duration funds focus on securities with a maturity of 1 to 3 years, and medium duration funds target maturities of 3 to 4 years. Long duration funds invest in instruments with a maturity of 4 years and above. Corporate bond funds prioritize highly rated corporate bonds, whereas credit risk funds invest in moderately rated corporate bonds with higher yield potential. Dynamic bond funds adapt their portfolio across all types of bonds for diversification, and gilt funds exclusively invest in government securities. Third category is hybrid mutual funds, which invest in a mix of asset classes, such as equities, debt, commodities, rights, and others. These funds offer the benefit of diversification by investing across multiple asset classes, balancing risk and returns. They provide stability through debt investments and growth potential through equity investments. Now let's understand the various subcategories of hybrid mutual funds. Hybrid mutual funds are classified based on their asset allocation. Conservative hybrid funds allocate 40% to equity and 60% to debt, focusing on stability. Moderate hybrid funds maintain a balanced allocation of 50% equity and 50% debt. Aggressive hybrid funds prioritize growth by allocating 65% to equity and 35% to debt. Dynamic asset allocation funds adjust their equity and debt proportions based on market conditions. Multi-asset allocation funds diversify across multiple asset classes, including equity, debt, gold, and real estate, for broader exposure. Fourth category is commodities funds, which includes gold and silver funds at present. Gold funds are a type of mutual funds that directly or indirectly invest in gold reserves. Investments are usually made on stocks of gold producing and distributing syndicates, physical gold, and on stocks of mining companies. Silver funds invest their funds in physical silver or silver-related instruments. The NAV of silver fund is directly dependent on the price of silver. To select the right mutual fund category for your needs, consider 3 things. First is your financial goals. Second is your goal period, short-term, medium-term, or long-term. Third is your risk tolerance level. It's always advisable to consult with a qualified financial professional like SEBI registered investment advisor to create a personalized investment plan tailored to your needs and financial goals. By understanding the different categories and subcategories of Indian mutual funds, you're better equipped to make informed investment decisions. Thank you for watching this video. Please like, comment, and share this video, and don't forget to subscribe our channel.